Okay, so once you have mastered how to buy stocks using common chart patterns like the cup of handle, double bottom, and flat base, the next step is learning where to find the proper areas to add shares to a winning position. The 3 weeks tight pattern is considered a follow up buying opportunity. Now, this should only be a fraction of your full size position. If you buy the same number of shares as your first purchase, your average cost will dramatically rise, and that could leave you more vulnerable to a loss if the stock pulls back to its buy point. So, the 3 weeks tight pattern forms in the middle of a stock's advance after a breakout. It represents a brief consolidation in which institutional investors pause their buying rather than take profits. The pattern occurs when there are 3 straight weeks with narrow changes in each weekly price close, no more than 1% to 1.5% up or down from week to week. Now, the weekly price changes generally shouldn't be wild. Even if weekly price closes are narrow and if one or more of the 3 weeks has the close that's low in the weekly price range, treat that pattern with some suspicion. Using JV Chemicals and Pharma as an example, let's see how the 3 weeks tight pattern works. JB Chemicals broke out from a consolidation on May 2020 and shares extended their gains. And then the stock formed a 3 weeks tight pattern. The weekly closes showed just fractional changes and closed very tight. Now, as the stock cleared the tight area, it started forming another 3 weeks tight. Once it cleared the tight range, it ran up 40% in a week. The stock formed another base on the 10-week line and more than doubled over the next 12 months. So remember, a well-formed 3 weeks tight pattern can be a powerful place to add shares to a winning position.